Someone paid $20,000 for 3 ATM machines last year. By month 4, those machines were clearing $1,100 a month in net profit. By month 14, that number was $1,600. Not because anything changed dramatically, because the operator learned where the volume actually lived, moved one machine, renegotiated one placement fee, and stopped making the 3 errors that were quietly draining the return. That is the whole story, compressed. What follows is the uncompressed version. First, the category. A boring business is not an insult. It is a description of durability. Boring businesses do not depend on a trend cycle, a content algorithm, or a charismatic founder. They depend on human behavior that has not changed and will not change. People need cash at inconvenient hours. They need their cars serviced. They need their laundry done. They need their buildings maintained. The customers are not there because something is exciting. They are there because something is necessary. That is a different kind of retention. It does not require a marketing budget. It does not evaporate when something newer appears. An ATM in a laundromat at 10:30 on a Tuesday night is not competing with anything. It is the only option in the room, and the person standing in front of it already knows what they need. Here is how an ATM route actually makes money. When a customer withdraws cash, the machine charges a surcharge. Typical range is 2.50 to 3.50 per transaction, depending on the location and the operator settings. That surcharge goes to you. There is also an interchange fee, a smaller amount paid by the customer's bank to the network, a portion of which flows back to the ATM operator. It is smaller, often 0.20 to 0.40 per transaction, but it compounds across volume. The machines that perform best are not in the fanciest locations. They are in locations with constrained alternatives and consistent foot traffic. A bar near a cash-only cover charge. A flea market open every weekend. A check cashing shop. A convenience store in a neighborhood where the nearest bank branch closed 2 years ago. Placement quality is not about prestige. It is about captivity and repetition. The unit economics at entry level look like this. A new ATM machine costs between $2,200 and $3,500 depending on the model and whether you are buying through a distributor or a reseller. A used machine in working condition can be purchased for $800 to $1,500. The cash inside the machine is your capital, not a cost. You load it, it gets dispensed, and it comes back to your bank account via settlement, typically within 1 to 2 business days. So if you load $3,000 into a machine, that $3,000 is not gone. It is cycling. The actual costs are the placement fee, which some locations charge as a flat monthly rate of $50 to $200 or a revenue share of 20 to 50% of surcharge income, plus processing fees, cellular connectivity costs if the machine uses a SIM card, and your time. A single machine at a decent location doing 150 transactions per month at a 3.0 surcharge generates $450 in gross surcharge revenue. After a 25% placement split, processing fees and connectivity, net profit per machine per month is often in the 180 to 280 range. 3 machines, 2 are performing, 1 is average. You are clearing $500 to $700 a month before your time is valued. That is the honest entry-level number. The mistakes that kill early returns are specific and consistent. Bad locations are the most common. An operator buys a machine, finds a business willing to host it, and discovers 6 months later that the traffic never materialized. The business owner said the location was busy. It is busy for the business. The ATM does 22 transactions a month. At that volume, you are not covering your costs. The second mistake is overpaying for the route itself. When you buy an existing route, the seller will show you revenue figures. Some of those figures reflect the best 6 months. Some reflect locations that are about to churn because the host business is behind on rent. You underwrite the route based on trailing 12 months, not trailing 6, and you visit every location yourself before closing. The third mistake is ignored downtime. ATMs go offline. Cash runs out. A paper receipt roll empties. A software update fails. Every day a machine is dark is revenue gone permanently. There is no recovery window. And the fourth mistake, which is quieter, is underestimating theft risk at low-quality locations. Smash and grab attempts happen, vandalism happens. The insurance exists, but the deductibles and the downtime cost real money and real time. Semi-passive at this level means something specific. It means you are not there every day. It does not mean you are not working. A 3-machine route at maturity requires roughly 4 to 6 hours per week of active management. Cash loading, machine checks, location relationship calls, settlement reconciliation. That is the realistic number. If someone tells you an ATM route is fully passive from day one, they are either running it at a loss or they are selling you something. The first 90 days have a checklist. Verify every machine's transaction history at the point of sale, not from a spreadsheet the seller exported. Establish your processor account and confirm settlement timing before the first transaction clears. Visit every location during peak hours to observe actual foot traffic yourself. Set a minimum transaction threshold, say 80 per month per machine, below which you immediately begin looking for a replacement location. Document each placement agreement in writing with a 30-day termination clause for both parties. Set a weekly calendar reminder for machine audits. And load cash conservatively at first, smaller amounts more frequently, until you understand the draw rate at each location. What you are building in year one is not a cash flow machine. You are building the judgment required to operate one. The difference between a $700 per month route and a $3,000 per month portfolio 3 years from now is almost entirely the accumulation of that judgment. The machines are the same. The locations are the variable. The operator is the asset. You found the first good location on foot, not online, not through a broker. You walked into a check cashing shop on a Tuesday afternoon, asked to speak with the owner, and had a 10-minute conversation that ended with a handshake and a site visit scheduled for Thursday. That is how most of the best placements start, not with a pitch deck. With proximity and a question asked in person. Location strategy at this level is not complicated, but it is deliberate. You are looking for 3 things simultaneously. Constrained alternatives, meaning the nearest bank or competitor ATM is far enough away to be irrelevant. Consistent foot traffic from people who carry less credit and more cash by habit. And an owner who wants a small monthly check for doing essentially nothing. When all 3 align, the placement holds. When only 2 align, it eventually doesn't. You prioritize bars, laundromats, flea markets, liquor stores, convenience stores in underbanked corridors, and small event venues. You avoid locations where the host sees your ATM as competition for their own revenue. You avoid anywhere the surrounding block changes visibly between day and night in ways that affect security. And you avoid any verbal agreement not signed within 7 days of the handshake. The ones that never get signed never hold. The placement agreement matters more than most new operators think. It does not need to be complex. It needs to cover 4 things. Your right to place and service the machine, the revenue split or flat fee and when it pays. A minimum term, typically 6 to 12 months, with defined exit clauses for both parties. And liability language that makes clear the machine is yours and the cash inside it is yours. A 1-page agreement signed by both parties is sufficient. An unsigned understanding is not an agreement. It is a hope. The operations loop runs weekly. You pull transaction data every Monday. You reconcile settlements against your processor reports. You flag any machine showing fewer than 20 transactions in the prior 7 days. You check connectivity status remotely if your machines support it and the models worth owning do. Cash replenishment is scheduled based on draw rate, not a fixed calendar. A machine drawing 80 transactions a week at a $3 average needs a reload every 5 to 6 days. A machine doing 30 needs one every 2 weeks. You learn the rhythm within the first 60 days and you schedule against it, not against the calendar on your wall. Maintenance is mostly reactive at this scale, but prevention costs less than repair. You keep 1 spare receipt roll and 1 spare card reader per machine model in your vehicle. You establish a relationship with 1 local ATM technician before you need one, not during a service emergency when rates double and availability shrinks. Compliance basics are non-negotiable. Your machines must display the surcharge clearly before the transaction completes. ADA requirements for screen height and audio apply depending on your state. Bank Secrecy Act registration is required if you are processing above certain thresholds. You read the current requirements for your jurisdiction once per quarter. They do not change often, but when they do, the fine for non-compliance is not small. Risk controls live in 4 places: the physical machine, the placement agreement, the insurance policy, and the cash management process. On the physical side, you anchor every machine to the floor or wall where the location permits. You do not place machines in locations with no interior cameras. You review security footage protocol with the host before you sign anything. Your insurance covers the machine, the cash inside it, and liability for customer disputes. A standard ATM operator policy runs $200 to $400 annually per machine. The deductible matters more than the premium. Know your deductible before an incident requires you to remember it. On cash management, you do not carry more than you need. You load to the draw rate, not to a comfort number. Cash in transit is exposure. Less cash in transit is less exposure. Record keeping at this level is not glamorous, but it is the foundation of every decision you will make later. You keep a simple log for each machine: date of service visit, transaction count since last visit, cash loaded, any maintenance performed, any location communication. A spreadsheet works, a notes app works. What does not work is memory. Memory fails on the third machine in the fourth conversation with a location owner who insists you never discuss the revenue split structure. Performance tracking comes down to 5 numbers per machine per month: transactions per day, uptime percentage, cost per service visit, net revenue after all fees and splits, and return on the capital deployed in that machine, including the cash float. A machine doing 4 transactions per day at 98% uptime and a cost per service visit under $30 is a machine worth keeping. A machine doing 1.4 transactions per day with recurring connectivity issues is a machine worth moving, not repairing indefinitely. The data tells you which is which. Your attachment to a location you worked hard to place will try to argue with the data. The data wins. Reinvestment decisions at this scale follow a simple rule. You do not buy a fourth machine until the first 3 are averaging at least 120 transactions per month each and have held that average for 90 consecutive days. You do not upgrade locations before that threshold either. And you do not add complementary services, a prepaid card rack, a bill pay kiosk, additional product, until you understand what the foot traffic actually converts to. Growth before stability is how a 3-machine route becomes a 3-machine problem. Basic hiring at this level looks like 1 reliable person who can do cash fills when you travel and 1 technician on call. You write down how you do every task before you hand it to someone else. Not a manual, 1 page per task, what the task is, what tools or materials it requires, what a successful outcome looks like, how long it should take. That document is the SOP. It is not sophisticated. It is sufficient. The decision rule for expansion is not a feeling. It is a number. When your existing route is generating $1,500 per month in net profit, is operationally stable with documented processes, and you can articulate where the next 3 placements will come from before you spend $1, you are ready for the next level. Not before. Everything before that is preparation disguised as operation. And preparation done correctly is not wasted time. It is the route itself running. At some point, the model breaks. Not dramatically. It breaks quietly, the way a routine develops a crack you don't notice until you're standing in it. You are now running 8 machines, maybe 10. The weekly Monday reconciliation that took 40 minutes at 3 machines takes 2.5 hours at 10. The cash fill you used to do yourself on Tuesday afternoons now conflicts with the location owner who changed his hours without telling you, a machine across town that threw a connectivity error at 6 a.m., and a service call you scheduled 3 days ago that the technician just rescheduled for the 4th time. You are still the operator. You are also the dispatcher, the accountant, the compliance officer, and the person answering a text from a bar manager named Terrence who wants to renegotiate the split because he saw your machine do 60 transactions last month and did the math himself. This is not a crisis. This is the signal. The signal says you are no longer managing machines. You are managing a system that is managing machines, and the system is not built yet. The shift from owner-operator to operator-manager is not about working less. It is about working on the right layer. You stop being the person who does the cash fill and become the person who designs the schedule the cash fill runs on. You stop being the person who calls the technician and become the person who maintains the relationship so the technician calls you back first. The distinction sounds minor. At 10 machines, it is the difference between stability and permanent triage. Acquisitions at this level follow a discipline that first-time buyers skip. Someone offers you a 6-machine route. The seller quotes you monthly gross and calls it cash flow. It is not cash flow. Cash flow is what remains after processor fees, vault cash cost, service labor, insurance, and location splits. You rebuild the number from source data. You ask for 12 months of processor statements, not summaries, statements. You verify transaction counts against reported revenue. You identify whether the best performing machines are in owned locations or month-to-month agreements that could dissolve 90 days after you close. A route priced at 3 times annual net earnings on verified numbers is a reasonable conversation. A route priced at 3 times annual gross on unaudited summaries is a seller's optimism and your problem. You buy the former. You walk from the latter. Operational leverage arrives in 4 places. Dispatching, meaning the route runs on a schedule derived from draw rates, not from whoever calls you first. Route optimization, meaning your fills are sequenced geographically so the person doing them is not driving past 3 machines to reach a 4th. Standardized maintenance, meaning every machine has a documented service checklist and every service visit closes with the same 5 data points logged in the same format. And vendor relationships, meaning you have negotiated consistent pricing with your processor, your technician, and your cash courier before volume makes you urgent and urgency makes you expensive. Urgency is always the most expensive procurement strategy. Build the relationships when you do not need them badly. Financing at this scale is not exotic. You use cash flow first. You use small business lending second. You use leverage conservatively, meaning you do not acquire a new machine or route unless the projected net cash flow services the debt at a coverage ratio you could defend to a banker who has seen operators fail. A 1.4 coverage ratio is a floor, not a target. The operators who struggle at this stage are not undercapitalized at acquisition. They are overcapitalized against fragile placements that looked solid in the seller's summary and looked different in month 4. People and accountability are where most small operators lose money they never see leaving. Your first hire is not a manager. It is a reliable route technician who follows a checklist without supervision. You write the checklist. You run the route with them twice. On the third run, you are not there. You audit the data afterward. Not because you distrust them, because auditing is the structure that makes trust operational. Shrinkage in this business is rarely dramatic. It is a few extra dollars kept here, a transaction count that doesn't match, a fill that gets logged as complete before the machine was actually checked. Prevent it with reporting rhythm, not suspicion. Weekly dashboards, machine-level transaction data, exception flags for any unit below threshold, reconciliation that closes every Friday whether or not you feel like doing it on a Friday. Expansion beyond ATMs belongs at this level only when the core route is genuinely stable. Adjacent assets, vending, micromarkets, bill payment kiosks all share the same fundamental logic. You place a machine that processes transactions, you manage cash and uptime, you earn on volume. The operational overlap is real. The mistakes transfer too. A vending route added to an undermanaged ATM route does not give you 2 revenue streams. It gives you 2 undermanaged routes. Add adjacent assets only when the primary operation has a reporting rhythm that runs without your daily intervention. Add them into locations where you already have a relationship. The incremental cost of selling a second service to a host who already trusts you is a conversation. The cost of building that trust from zero is months. Your reporting rhythm becomes the central operating document of the business. Weekly dashboards cover transactions per machine, uptime, cash loaded, exceptions flagged. Monthly reviews cover net revenue per machine, return on deployed capital, any location at risk, any acquisition opportunity in the pipeline. Quarterly audits cover compliance status, vendor contract terms, insurance coverage, and whether the machines performing in the bottom quartile are worth keeping or worth moving. You review exceptions immediately, not at the end of the month. Exceptions deferred are problems compounded. The machine count is not the measure of the business. The reliability of the cash flow is 40 machines generating predictable, documented, auditable income with a system that runs whether or not you are physically present is a different kind of asset than 40 machines that require you personally to stay standing. One is a route, the other is the beginning of something worth owning at scale. At the highest level, something fundamental changes in how you see what you own. It is no longer a route. It is no longer a collection of machines. It is a portfolio of cash-producing assets that behaves more like a small private equity platform than a service business. The people who reached this level did not arrive by accident. They arrived by treating every prior stage as a discipline, not a destination. And then one day the business is large enough that the way you think about it has to change entirely, or the business will stop growing in the right direction. Portfolio thinking means you stop evaluating assets one at a time and start evaluating them in relation to each other. An ATM route generating $140,000 in net annual cash flow is one thing in isolation. Paired with a vending operation running $90,000 net and a micro-market contract adding $60,000 more, all 3 sharing one route technician, one back-office accounting function, and one insurance umbrella. The combined entity generates $290,000 net on a cost structure that does not scale linearly with the revenue. That is the point. The overhead does not triple because the revenue streams did. Shared operations compress costs, shared finance compresses complexity. Shared sales relationships turn a single host conversation into a multi-service contract. The platform earns more per dollar deployed than any individual line ever did on its own. This is when governance stops being optional. Clean books are not an administrative preference at this stage. They are a capital markets requirement. If you ever intend to bring in outside capital, pursue a partial recapitalization, attract a strategic partner, or sell any portion of the business, the quality of your earnings record is the asset being evaluated. Not the machines, not the locations. The documented, auditable, accountant-reviewed record of what the business actually earned, net of every real cost, across time. Private equity buyers and strategic acquirers do not accept seller summaries. They commission quality of earnings analyses. Those analyses are looking for add-backs that don't hold, revenue that isn't recurring, customer concentration that creates fragility, and owner-dependent functions that would disappear the day you leave. You build against all 4 of those findings long before anyone asks. Due diligence readiness is a posture, not a project. You maintain it continuously. Contracts on file, location agreements current and signed. Processor relationships documented, technician arrangements formalized, insurance certificates current, tax filings clean and on time. Entity structure organized so the business is separable from your personal finances without a months-long untangling process. If someone called you today and said they wanted to begin preliminary diligence in 60 days, your answer is yes because the answer was always yes. You built for that. Protecting durability at this level requires explicit attention to the risks that don't show up on a profit and loss statement until they do. Compliance with state regulations governing ATM surcharge disclosures, ADA accessibility standards, and network operating rules is not a background concern. It is operational infrastructure. A compliance failure at 40 machines is not the same problem it was at 5. Cybersecurity for machines connected to payment networks is a real liability. Your insurance coverage, property, general liability, cyber, and business interruption should be reviewed annually against the current scale of the business, not the scale it was when you originally bought the policies. Key person risk, meaning the business is dependent on one technician, one manager, one relationship, requires active mitigation. You document processes so that the person who runs them can be replaced by the documentation if they leave. Redundancy is not pessimism, it is what durable businesses are built from. Exit and liquidity options at this level are plural, and understanding them changes how you make decisions today. You can hold forever and extract cash flow annually, which is a legitimate and often underrated outcome. A business generating $290,000 net annually on assets you own outright is a personal endowment. You can pursue a partial recapitalization, taking chips off the table while retaining an operating stake, which provides liquidity without a full exit. You can pursue a strategic sale to a larger operator or platform that values your locations, your volume, and your clean operating history. Or you can become the platform yourself, rolling adjacent operators into your entity and presenting a combined business to the capital markets at a multiple that reflects institutional scale. Each path requires different preparation. None of them forecloses the others if you maintain the discipline that makes the business worth acquiring in the first place. Here is the reality check, and it matters. Most people who start a route will not reach this level. Not because the path is hidden, but because each stage requires a different version of the operator. The person who was excellent at filling machines personally may resist building the system that replaces that role. The person who was excellent at managing 10 machines may resist the governance and formality that a 40-machine platform requires. Overexpansion is the most common failure mode at this stage. It looks like ambition but runs like fragility. You add a third revenue line before the second is stable. You acquire a route at a price justified by optimism rather than verified earnings. You hire ahead of revenue and then cut people when the revenue doesn't arrive on schedule. The discipline that built the business is the same discipline required to scale it. It does not change character at the top. It just becomes more consequential when you get it wrong. Pick one boring model, not 3. 1. Learn its unit economics until you can explain them to a stranger in 4 sentences and defend them against a skeptical accountant in an hour. Build the reporting rhythm that makes the business legible to you, to a partner, to a lender, and eventually to a buyer. Protect the cash flow before you expand it, and take the next step, not the next 10 steps. The machine that compounds quietly is the one maintained with patience, not the one accelerated past its own stability. The boring business was never the limitation. The operator's willingness to master it was always the variable. That variable is still yours.